President Trump targeting the Fed yet again on Twitter today, saying the Federal Reserve is derelict in its duties if it doesn't lower the rate and even idly stimulate. Take a look around the world at our competitors. Germany and others are actually getting paid to borrow money. Fed was way too fast to raise and too slow to cut.
Props to you for trying to get through that.
Well, the derelict, all I can think of is, that movie, Derelict. Zoolander, thank you. Ed Al-Hussainy, Columbia Threadneedle Investment Senior Interest Rate and Currency Analyst. I make a joke about the tweet with derelict or derelict, but at what point does someone say to the administration, shut up? I mean, the Fed is independent.
Well, lots of people have said shut up.
They have.
I mean, the question is, I think it's a good question. I have no idea, is probably the correct answer. The question is, at what point does that bleed into the Fed's thinking?
Is it?
And there we don't have a lot of transparency. We will know in a number of years when those transcripts come out.
That's 5 years, right?
5 years.
We get the actual.
That's right. And some of the folks who are on the Fed now will still be around at that time. So far, I want to say, look, the Fed's thinking in terms of its outlook, in terms of how it's managing the risks, is in some ways converging with some of the criticism coming from the White House.
And I think it hasn't just been the Trump tweets. I think it's been reacting to what the markets are doing more than anything, and maybe looking like, even though that's really not the job, sometimes what Powell has said has appeared really to be a reaction to how stocks are moving, or at least an acknowledgement that his remarks are so picked apart and that stocks can often move one way or the other just based on what he says.
Well, we've had guests, by the way, who've been on this program within the last week who've said, don't expect a rate cut next week. You're saying those guests are wrong. Why?
I think they're incorrect. First, it's fully priced. And given the Fed's skew in the course of this past 9 months in terms of easing, undoing some of that now by surprising the markets and staying on hold would be counterproductive. So I think in terms of the move next week, it's likely to be a cut. And the real question now is how much forward guidance do they give us for the rest of the year and well into 2020? What's the criteria for further cuts? And at what point will they stop and essentially call the end to an insurance cycle? From my perspective, it's premature to do that. If you look at the intra-meeting data, it's deteriorated. If you look at the outlook for 2020, it hasn't necessarily improved. So the onus on the Fed, I think the pressure on the Fed to provide accommodation is still very much with us.
And so how do you strategize around that?
Yeah, so the way we've been positioned is we've looked at across the curve, what does the risk reward look like? The front end seems much better anchored by the Fed's policy reaction function, the fact that the data is continuing to skew weaker both in the US and globally, and of course some of the secular factors that have been with us now for a number of years, particularly inflation, and the fact that inflation is struggling to get to that 2% threshold. That I think protects us in the front end. And I think, again, the odds of Fed funds going to zero by next year, by next summer, is considerably underpriced by the markets. We only have about 50 basis points now in the price. So we like being long in the front end.
Jennifer, I'm just curious if you would agree with Ed that the market might be underpricing this.
I mean, it's hard for me to say. I think you're more of an expert on this than I am. But I'm actually curious about what you said earlier. If next week, there is a rate cut, what is the biggest consequence that, we should be looking for in terms of something to be aware of, right? In the biggest concerns or potential negative effects from that we should be concerned with?
That's right. And one of the criticisms, and I think, at some point this will be a valid criticism, is the fact that easy monetary policy on a cumulative basis from the Fed, from the ECB, from the Bank of Japan, the excess liquidity in the global system will start to show up in the form of asset bubbles. I will say that at the moment, there's really no indication that that's happening. It's an evergreen concern that monetary policy translates into asset bubbles. I think we look at historically, two things in my mind are true. First, it's the distance between easy monetary policy and asset bubbles is significant. A lot of things have to happen in between, and a lot of them have to do with market psychology. And conversely, tight monetary policy is not very good at popping asset bubbles, and we saw that in the mid-2000s with the housing market. So I think the Fed is going to continue to marginalize those concerns, at least in its current framework.
All right. Ed Al-Hussainy, Columbia Threadneedle Investments. Good to have you here as always on the move.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.